Yeah, so I think we'll definitely get into some of the misunderstandings. Hopefully, we can touch on valuation and how you think through that. Maybe just to start off, there's been this idea circulating online that Hims is going to be the Netflix of healthcare. There's an article in Sherwood, I think that's Robinhood's media subsidiary, that used that moniker, Netflix of healthcare. Even Andrew, in the interview that we had with him, referenced Hims like wanting to be, and um, eventually, if you look 5, 10 years down the line, becoming the Netflix of healthcare. The proper way to view this business is not to obsess about any single product, say GLP-1s, but to view it as a healthcare platform. What do you think about this analogy? Do you think it holds up?
Yeah, I mean, Netflix is the first thing when I heard that was that's a tall, that's a tall task. Um, but in general, I think that's right. I mean, you know, we'll do baby steps first. Netflix is probably like the last step. But it's what is it, 400 billion market cap or something like that. But baby steps is let's get to 40 billion. That's not a baby step. That's a big win. So basically, I mean, my view of this is it is very hard to build a large company. I've done it. I built a $1 billion publicly traded company. So I feel a lot of kinship with Andrew. In he started the company in 2017, and he took it public in 2020. That's like very much almost exactly the same thing that I did. But he, just a couple of years later, he was a young guy. And like I said, it's not easy to do that. Everyone wants to do that. Every single kid out of Wharton wants to start a company, take it public, and be successful. It's a 1 in a million because it is so freaking hard. And I think that the growth of Hims, specifically on the revenue side, is really suggestive of a special company. I always like to tell people that if a company has a second derivative of revenue growing, it's a very odd and unusual phenomenon. So Google was an example. I remember the Google IPO. People weren't that excited about Google, by the way. People were excited, but it wasn't IPOing at a 200 billion market cap. It was IPOing at a 20 billion market cap or 40 billion. I forget exactly. But what was weird about the revenue was that as the company got bigger, the revenue growth didn't slow. It actually got a little bit faster, which sort of defies logic because, as you incrementally add salespeople or as you get scale, your revenue growth should slow down. It shouldn't just, sort of keep going up. So the second derivative revenue is also very, very positive for Hims. And it's also positive for Palantir, which is why Palantir sort of done what it's done. It's really hard to find companies that are actually growing faster every quarter over quarter every year. And as you guys know, I'm a big short seller. In fact, I've made, just insane amounts of money short selling. And that's my shtick, really. What people know me for, at least on the trading side, is I love to short biotechs, tech stocks as well. I've got big short in the quantum computing space right now. So I'm not a fool or a Pollyanna. I'm very easy and quick to turn it around and short sell. But I think that this kind of growth is suggestive of a company that is hasn't even sort of touched its addressable sort of space. So I do think that the founder-led company is one of the most powerful things in the world. He's sort of still a kid in some ways, and to be able to sort of grow into that and succeed at this level, it takes a special kind of person because it kind of reminds me of Mark Zuckerberg. Zuckerberg was sort of a fish out of water being a CEO. Really hard to just become a CEO of a growing company, but he pulled it off, and he sort of navigated himself into a way where he could be the CEO of a publicly traded company. He could grow it. He could focus on strategy. And this market is as big as it gets. Healthcare is, everybody knows, multi-trillion-dollar market. It's got a lot of inefficiencies. You talked a little bit about Daraprim. There's enormous inefficiencies in healthcare. Some people seek to exploit them. Some people seek to reduce them. Some people, just sort of operate in the space in a very inefficient way. So to me, I'm super impressed by the company's ability to grow faster over time. I know the GLP space like the back of my hand because I am the farmer bro, but I think that there is something bigger here, a lot bigger than GLPs. I think to me, it's just, yeah, it's just a fantastic company that's executing really well, and the valuation is really exciting. And that's kind of where I think people will get into that if you'd like. But kind of what I'm saying in a roundabout way is when you look at the Googles and Palantirs, a lot of people think about price to sales or something like that. And it's just absolutely wrong way to look at it. And, when Google went public, there was a hedge fund. I worked at a Tiger Cub called Intrepid, and there was another Tiger Cub called Lone Pine. And Lone Pine bought almost all of the Google shares in the IPO. It was bizarre. They became the second largest shareholder of Google. And I think the largest institution, maybe Fidelity or like Vanguard or BlackRock had more. But this was a really big bet for Lone Pine. And they saw something in Google that nobody else could figure out. So this was what, 2006 or something, 2004 or 5, 6. And the when a company like that is growing 30, 40% a year, the second derivative is growing, and their TAM, they've only taken a small, tiny bit of the TAM. You basically have to throw a lot of the valuation stuff out of the window and fast forward a few years and say, or let's say they got, in Google's case, they got all the TAM, but let's say they got a lot more of the TAM than maybe, they have now. Maybe several fold or several logs in Google's case. From 1% to 80 or 90%. HIMS, if you assume they do something like that, I mean, their earnings potential for the company is just insane. I mean, I think they can earn $5, $10 a share in earnings, which, you don't have to be Warren Buffett to know that's, a really, really cheap stock. And if you focus on today, well, it's important that they execute today. They have to have good quarters. They have to take one step in front of the other. But the company has that rare combination of vision and execution. And when the company announced its recent quarter, I thought this was a great time to buy because I think the GLP situation is. Well, I'm curious what you guys think, because in some ways I think it's transitory, and in other ways I think it's obviously some trend they want to sort of exploit on the compounding side. And then finally, to me, at the very least, it shows that you're a management team that's really hungry to create shareholder value, which you always love to see. And that whether or not they hit the home run with GLP, it just sort of doesn't matter because they're that hungry to create shareholder value. They're going to hit the home run on something. And they're already hitting home runs with their revenue growth.
Martin, I think in some ways you kind of touched on the question I was going to ask you, so I'm going to do an audible here and shift my question a little bit. I was going to ask you about management, and you can come back to that. I mean, specifically, I think the question I was going to ask you would be, you've been in that space, what would you potentially do differently? But instead, you can still come back to that. I'm going to touch on something you were just talking about instead. You mentioned Google. I'm not sure how many of our listeners know that history. Certainly know it better than I do, but I remember a little piece of it which might be relevant to this story. There was another company, we're talking more than 20 years ago, called Overture. I'm not sure if you remember it.
Of course, yeah.
Okay. They were kind of in the same space. I almost kind of view them as the Yahoo of advertising at that time, in the sense that it wasn't really automated to my memory, but they were doing this placement of the same kinds of text-based ads. Google came along and ate their lunch. I mean, they just completely stole it away from them. And I don't even know what happened to Overture, if they got bought up or whatever, but it was just gone. So to me, since we were just talking about Google, in that history, you got two companies. One was sort of an innovator. Google, I don't know if it may have been around longer, but Google seemed like the late comer to the advertising space and then just swamped Overture. So what about HIMS? HIMS might be seen as an early mover, very successful. You got others out there like Amazon. There could be other players that don't even exist or not even on our radar screen right now that could completely swamp them the same way that Overture was swamped by Google. And if you feel like wrapping in there your experience personally as an innovator and someone who's worked in this space, where do you place HIMS in that story? Is HIMS necessarily the innovator that's going to swamp others? Maybe that's what we're hoping for. But what is the danger that the opposite is the case?
Yeah, no, this is sort of the $64 billion question. I mean, we can't as investors, we can't always see the future. And even somebody who spent a lot of time in pharmacy and in, that space, which, I'm more in pharmaceuticals than pharmacy. One guy, if you guys haven't talked to him yet, is the founder of PillPack. Would be a really great person to talk to. It sounds like maybe you have.
They got bought by Amazon, right?
Yes, that's right. Yeah, he's a friend and somebody who's I would say literal genius in this space. He was the only guy I put up there with Andrew, and I'm sure he'd come on. But
I'm seeing TJ Parker, Elliot Cohen.
yeah,
Do you
TJ.
recommend TJ?
Yeah.
Okay. I'll reach out. Cool.
And so I think as investors, one of the hardest things to do is to predict the future. And the reason I tell the Lone Pine story, which is really like Wall Street inside baseball or hedge fund inside baseball, is that a lot of the times, like all the models, all the forecasts we do, all the customers we talk to, all the stuff we look at near term, all those tools fail us because we have to sort of look at the entrepreneur, trust in them. We give them the capital. In this case, we're secondary shareholders, but they've already raised their capital. And we just sort of watch them work. And I feel like HIMSS is one of those kinds of companies where, I mean, I can make lots of elaborate forecasts, but do I know what Andrew's going to do this year or next year or the year after? Of course not. It seems to me that he's executing like a madman, right? This is a company that, what really shocked me, I forget, somebody was, my chat rooms are always full of people talking smack, but somebody was talking smack about it and said, you got to avoid this stock. And I said, in 2019, these guys did 83 million in revenue. Okay. And last year they did 1.5 billion. Have you, I said to that person, have you ever done anything that comes close to that? Like, I don't know if there are any companies that in the last 5 or 6 years have had a 20x increase in revenue. And it's just such a remarkable and phenomenal win. In terms of competitors and stuff like that, I mean, it's almost like sometimes we want to find a way to create a new industry. And I think for the longest time in Silicon Valley, when you talk to the A16Zs or the founders funds or the Sequoias, these guys have tried so hard. And a lot of these guys, I think, invested in HIMSS originally. By the way, great hedge fund called great VC fund called 8VC. Is the co-founder of, you might want to get him on as well. He's the co-founder of Palantir. They were an early HIMSS investor when it was private. And
you didn't know Joe Lonsdale, right?
Yeah.
You didn't know Joe invested in HIMSS.
Yeah.
Yeah, we'll have to reach out to him.
Yeah, and I mean, Joe's about as good of an investor as anybody. I don't think you could beat his track record. And I guess the point I'm making is the Silicon Valley has tried for the last 10 years, longer than that probably, but especially the last 5 or 10 years, they've tried to say, how do we point tech at healthcare? How do we point software at healthcare? And nobody has made it work. There have been so many disasters, write-downs, things like that. And, this is one company that's actually made it work, and it's working. Now, if I were Andrew, the world is your oyster here, and kind of what not to do is probably the hardest, thing to work on, because all of healthcare is broken. It's there are a lot of reasons behind that, but he hasn't gotten into telehealth as far as I know, which is a space that's attracted a lot of people. Sort of wellness management is another space that's attracted a lot of people, and he sort of has executed in a space that's actually generating cash flow.
By telehealth, you mean like primary care?
Connecting you to a doctor over video chat, the teledoc, sort of type of experience. And, I think he's navigated to a place where, look, the guy's got 80% gross margins. I mean, that's a software company, right? The rest of these companies that have wanted to do this, what they end up finding is that they're a healthcare services company. And you don't want to be a healthcare services company if you can help it, because you're going to have 10%, 15% gross margins. So I'm really impressed with Andrew's ability to sort of find a way to apply technology to healthcare, which just look at the revenue growth. Like I said, 80 million to, it'll be what, two or so billion this year. I think 2.4, but I don't want to set a bar higher for anyone else. I think the street's at 2.2 or something. You know, how do you grow that fast? It's because the market is begging for tools. It's not because, look, as much as I like Andrew, you don't grow from 80 million in revenue to 2 billion by accident. Part of it is, of course, their execution, but part of it is the customers are begging you for something. There's something happening where they want to give you their money. It's hard to sell product. Our startup's starting to do very well, but before we focused on financial software, we tried a couple different things, and it was impossible to get customers. We're now sort of solving a need some people have, so customers are sort of throwing their money at us, and it's two very different feelings. And some people call it PMF, but he's clearly hit on something that is growing like a weed. And I think that as he tries to expand around that, it'll be curious and interesting to see what pockets of healthcare he's going to focus on, because it is a $3 trillion business just in the US, and a huge chunk of it is broken. We saw Walgreens getting taken over for a value that's arguably kind of less than Hims was a few months ago. So, you have, a chance to be as big as a CVS or even a United Healthcare. What does United Healthcare do that's so special that they're worth 400 billion? If you think about, it's a great company, but if you think about United Healthcare, they're not an insurance company, so it's not the capital. A lot of people sort of think about health insurance and say, well, an insurer has to take the risk in case I get hit by a car. And if I get hit by a car and I need this complicated surgery, it's $3 million and I have to pay for it. But that's not what United Healthcare is doing. They're sort of a pass-through mechanism. And that's why health insurance got rebranded to managed care. And managed care is something that's, a very different process, where basically they take your health costs and they add 10 or 15% to it. And when I raised prices on drugs, Daraprim was the one I was well known for. And I did this all with the double interest of course, growing my revenue and growing my cash flow as a publicly traded company. But also there were situations where it actually would help the patient. And I won't go into that in great detail, but I never once had an insurer say no. Never once. I never once had an insurer say, hold on, why do we need to raise the price here? And the reason for that is you can't grow volume as an insurance company or a managed care company, because there's only 300 million people in the US and they're divvied up amongst 5 insurance companies. So they're not going to be more people. So everyone's got a plan. The only way you can grow your earnings is if the cost grows. It's kind of like a defense company like Lockheed or Boeing. They are incentivized to spend as much money as possible. And that's why we've had this runaway spending, because they get 10% of that. If Lockheed can deliver a new fancy jet plane for $50 million or $200 million, well, they make 10%. So they'd rather deliver it for $200 million. So when I raise the prices of these drugs, the insurance companies are saying, let's go, Martin. All right, keep it coming. Because next year we get to charge even more premiums. And we know we're not going to get more people. So the only way we can really grow is our margin on premiums. So there's a broken system there. And if you think about the value that UNH extracts at $400 billion market cap, and they do provide a service. They help doctors who want to treat patients have a network where they can almost get a guaranteed payment. So if Hims, this is just a random example, but if Hims points their machinery at that, their ability to execute and succeed, then they can get a piece of that market. The reason I say this is far afield from what Hims does today, but if you look at this space, sort of the digital pharmacy space, there have been thousands of companies that have tried to do this. In my Rolodex, I have like 600 people that have tried to do this. I even did an appearance for one, which was funny. They begged me, Martin, can you come to our launch party? And, everyone and their brother wants to start an online pharmacy. But Hims has executed. And when people say that in my chat room, they say, well, Hims has no moat. And said, well, it appears their customers love their product. So that's kind of the moat. If your customers, Walmart has no moat. You go start your own convenience store tomorrow. So let me know how it goes. It's not that easy. Getting sourcing right, getting pricing right, getting branding right, getting all those things right is something HIMSS has been able to do. So I think the next time they point their, I call it machinery, but their expertise, their organization at some target in healthcare, I think that, it's just going to be another like 10x opportunity where you could see the company have 10 billion in revenue. And I'm sure they have a plan to do it. But, you and I are not necessarily going to get that plan. As investors, we got to keep our ear as close to the ground as possible, watch their job postings, do everything we can to sort of get an inkling of what's next. But management is ultimately the bet, I think, in so many ways. And as a fundamental value investor, I like to look at numbers and crunch them all day. But, sometimes you do have to sort of take some faith that the management's going to do the right thing. They've certainly done it so far.